Hello traders and welcome back to the new video of Nova Forex. The supply and demand zones are often respected into the market. So, this video would be a complete guide on the supply and demand zones. We would share the best ways to plot the demand and supply zones which are made by the central banks and financial institutions in order to fulfill their unfulfilled orders into the market. But before we start the video, make sure that you subscribe to our channel and hit this bell icon as we upload new videos every week. Now before we share the best ways to plot the demand and supply zones into the market, let us look at some of the basics of the supply and demand zones. We need to learn about the support and resistance concept in order to understand the supply and demand zones. Let us learn about these concepts with an example. So, as you can see here that the market is in an uptrend as it is making higher highs and higher lows. We can see that the price went to upside after reaching to this zone twice. And thus, we can say that this is a support zone as it provided support to the price 2 times before. And which is why there is a higher probability of price going upwards after returning back to the zone. Now let us learn about the resistance zone into the market. So, as you can see here that the market is making lower highs and lower lows which indicates that the market is in a downtrend. And then we see price going downwards after returning to this zone twice. And thus, we can say that this is a resistance zone as it provided resistance to the price 2 times before. And thus, there is higher probability of price going downwards after returning back to the zone for the 3rd time. A resistance zone is said to be valid only when the market falls at least 2 times after returning back to the zone, and which is why there is a higher probability of market going downwards after reaching back to the zone for the 3rd time. The price usually moves into the range of support and resistance level. Now let us move on to the meaning of supply and demand zone. The supply and demand zones forms in the market when the smart money, that is central banks and financial institutions, accumulate orders in large quantities which results into formation of big red or green candles into the market. The demand zone simply means the zone where there is a large demand of the asset. A large number of traders initiate their buy trade into the market when the market reaches at the demand zone as they think that the price has become cheap. The market makes big green candles as a lot of buyers have entered into the market from this demand zone. Similarly, the supply zone are the areas at which the market falls after reaching to that zone. When the market reaches to the supply zone, a lot of traders initiate their sell trade into the market thinking that the price would again go downwards like it did before twice. Now before we dive deep into the concept of best ways to draw valid demand and supply zones into the market, let us learn some of the smart money concepts which are necessary to learn in order to plot a valid demand and supply zone. We need to learn about these 3 concepts in order to plot a demand and supply zone. Break of structure, fair value gap and order blocks. Let us learn the first concept, which is break of structure. The break of structure occurs when in an uptrend, the market breaks its most recent higher high to the upside. The break of structure during an uptrend indicates that the market wants to continue its uptrend. Similarly, as you can see here that the market is making lower highs and lower lows into the market which indicates that the market is in a downtrend. We can see market breaking its recent lower low to the downside which we call break of structure. The second concept is fair value gap. The fair value gap is a gap which is created by a big candle. The gap between high of the previous candle and the low of the next candle of the big candle is called a fair value gap. The bigger the fair value gap, the more active the smart money is into the market. The third concept is order blocks. The order blocks are the refined areas of demand and supply. The order blocks form when the central banks and big financial institutions accumulate orders into large quantities. The smart money forms the order blocks in order to fulfill their unfulfilled orders into the market. The smart money manipulates the price and brings it back to the order block zone in order to take entries or exit from the market. Now a question might arise in your mind that why should we draw the supply and demand zones on our chart? The reason behind this is that by drawing the supply and the demand zones, we can easily know the area from which the market would reverse. The smart money, that is central banks and large financial institutions, uses this supply and demand zones in order to fulfill their unfulfilled orders into the market. If we trade using this supply and demand zones into the market, then we can get up a profitable trade into the market as we are trading with the smart money. Now that we have learned the basics of the smart money concepts, let us move on to how to plot demand and supply zones properly into the market. Let us learn how to plot the demand and supply zones into the market with an example. Let us begin with the first way of plotting the demand and supply zone into the market. Here we have the Euro-New Zealand dollar chart on 1 hour time frame. So, as you can see here, that the market is doing the break of structure to the upside, which indicates that the market is in an uptrend. And then we see market forming an inefficient candle after the break of structure, which made a fair value gap. And thus, we would plot the demand zone from the candle that formed before the imbalance candle. Now we would initiate our buy trade once the price reaches to the demand zone. We would initiate our buy trade from this point. Remember one thing, that you should always keep the stop loss below the demand zone, as the market has the tendency to hit the stop loss of the early buyers and then move upwards. Let us see one more example of this way of plotting. Here we have the Euro-Canadian dollar chart on 1 hour time frame. So, as you can see here, that the market is making lower highs and lower lows, which indicates that the market is in a downtrend. And then, we see market forming big red inefficient candles after the break of structure and with a big fair value gap. And thus, we would plot the supply zone from the candle that formed before the inefficient candle. Now we would wait for the price to come back to the supply zone in order to initiate our short trade into the market. Here is our entry point. We would keep our stop loss above the supply zone and place our targets at 3:1 risk to reward ratio. And as you can see, that we made a nice 3:1 risk to reward ratio through this trade. Now let us move on to the second way. So, as you can see here, that the market is making higher highs and higher lows, which indicates that the market is in an uptrend. We can see market going into the consolidation phase. And then we see market forming an inefficient candle which made a big fair value gap. Now we would not draw the demand zone from the last candle that formed before the inefficient candle. Instead, we would draw the demand zone from the high to the low of this consolidation phase. Remember one thing, that when the market makes an inefficient candle after the consolidation phase, then we must draw the demand zone from the high to the low of the consolidation phase, as the market has the tendency to hit the stop loss of the early buyers and then going upwards. Now that we have drawn the demand zone into the market, let us wait for the market to retrace back to this zone in order to initiate our buy trade into the market. We can see market coming back to the demand zone, and which is why we would initiate our buy trade from this point. We would keep our stop loss below the demand zone and place our target at 3 times the stop loss. And as you can see, that we ended up making up a profitable trade into the market. Now let us see one more example of this way in order to make sure that you understood it properly. So, as you can see here, that the market is making lower highs and lower lows, which indicates that the market is in a downtrend. We can see market going into the consolidation phase. And after that, the market made an inefficient candle along with the break of structure to the downside. And thus, we would draw the supply zone from the high to the low candles of this consolidation phase. Now we would wait for the price to come back to the supply zone in order to initiate our short trade into the market. We can see market coming back to the supply zone, and which is why we would initiate our short trade from this point. We would place our stop loss above the supply zone and keep our targets 3 times the stop loss. And as you can see, that we ended up making up a profitable trade into the market. We must know one thing, that the price does not always comes inside the demand and supply zone and then continue its previous trend. Sometimes the price comes close to the demand or supply zone but does not come inside it. Let us see one example of it. So, as you can see here, that the price is making higher highs and higher lows, which indicates that the market is in an uptrend. And then we see market forming an inefficient candle after the break of structure, which is why we would plot a demand zone from its previous candle. Now we would wait for the price to come back to the demand zone. And as you can see that the price came close to the demand zone, but it did not touch it, which is why we should place our entry above the demand zone in an uptrend and below the supply zone in a downtrend. This brings us to the end of this video. But before we end this video, if you found these video useful, then don't forget to like the video and make sure that you subscribe to our channel and hit this bell icon as we upload new and effective smart money trading strategy videos every week.